Welcome back to episode 13 of Talking Stocks. My name is Joe. I'm here with Todd, as always. How are you, Todd?
Good, lucky 13. I think
Yeah.
like in elevators, Joe, maybe we should skip 13, go
Yeah,
straight
maybe
to
we should call this episode 14 for the sake of karma. Who knows?
That's right. I don't know how much of a gamble do we want to take especially when it comes to, the market that we've been in, how crazy high things have gotten out of control, theoretically gotten out of control. Do we really want to be tempting fate with episode 13? But so be it.
So
There it
be it.
is.
Here we are. I
Wednesday.
said it already. We're too late. Yeah, so let's jump in because I know there's some news this morning that's kind of hot off the press that you actually brought up before we started recording. I hadn't heard anything about it. This new kind of stimulus rumor. So fill us in for those who haven't heard.
Well, we could be back in business yet again. It's almost like it's like the cheese that they keep pulling along to try and coerce us towards the end game. But once again, I think it was Politico came out saying that we could see a $900 billion stimulus deal as soon as today, which is weird because that means they're doing a lot of behind the scenes things when they're not even there. I mean,
Right.
we've got the holiday and everything else, right, Joe? So I mean, it seems a little bit awkward to me to be betting on this as an outcome, especially since again that cheese has been it's like the Charlie Brown with the football. It keeps getting removed.
Exactly.
And I go to kick and whatever. But I mean, it's been this ongoing debate of will stimulus come, and if the stimulus comes, how much will it be? And I think one of the things that's interesting about that is we talk on the show about the markets being a forward-looking instrument, right? It's always kind of like looking ahead and saying, okay, well, it's not based on what happened yesterday. It's based upon what's likely to happen over the course of the next 6 to 9 months. And one of the things that's interesting is that, if you look at our sector report, and we put them out every week for our listeners, there's a link in the bottom. You can get a free subscription to a trial so you can see what the sector rankings are. But we get these sector rankings every week. And for months, financials have been strong. And that's kind of, gone in the face of maybe what conventional wisdom might dictate, right? You look at it and say, well, why would I want to own a bank when, businesses are closing and people are at risk of defaulting on their personal loans, their credit cards, et cetera. And I think this is really what the market is sniffing out. It's sniffing out the eventuality that we do get stimulus. People do end up with money in their pockets, and they do have a little bit of additional faith in that playing out because of what we saw earlier this year. I mean, the stimulus package that passed early this year was, I think, pretty successful as far as taking us from a negative 30 GDP growth, getting us back on track, and protecting people from default because they were, had that extra $600 a week in their unemployment. So if they had been laid off because of COVID, they didn't have to worry about that. In some instances, that gave them enough financial flexibility where they were actually able to not only make their payments, but actually go out and consume, right? And drive up sales. I don't think they're talking about $600 this time around. I think they're talking about an extra $300 for up to 16 weeks of additional unemployment insurance. But again, as an investor, what we're doing is we're looking at it and we're saying, okay, well, that makes sense now. Okay, financials are scoring really high in the research. Banks are scoring really high. Conventional wisdom would be for that not be the case. But if we do get stimulus, that adds to the whole argument. Yeah, you know what, Joe? Maybe it is a good time to go out and buy a high-scoring bank like U.S. Bancorp or Citibank or one of those. There's a lot of them, a lot of mid-cap and small-cap regional banks as well. We're just going out, Joe, and saying, you know what? I'm not sure. I don't want to pick the winner and loser in the space. I'll just go out and I'll buy the ETF, the regional bank ETF, KRA.
Yep. I just pulled up, when we record these, I have another monitor that has Fidelity Active Trader Pro up on it. And so a lot of times I'll be pulling up charts as we kind of go along in our conversation. And I just pulled up Prudential Financial, which I believe was the highest or one of the highest scoring stocks in our research last week. I don't know if that has held up, but I'm guessing it has, and they're up about 0.5% today. So there's definitely like they're down. They got down into the 76 range in the past few days, down from like 81. So I think there's definitely a potential entry point there, and I'm guessing that pattern holds for similar banks out there.
Yeah, and there's some seasonality associated. Insurers tend to do well into the end of the year. I'm not really sure why. Maybe it's because of storm season, winter storm season and stuff. But I mean, Travelers scores really well too. Progressive scores really well. So insurers would be an option for people who are interested in financials but don't want to participate in the banks.
Yep, absolutely. All right, so we're kind of on the topic of financials now, and so I had this idea that we might even make this a kind of recurring segment, depending on how our viewers and listeners think about this. So if you like this idea, please let us know. Comment, tweet at us, whatever. So I want to take two pretty similar stocks, and I want to compare them, and I want to hear like want to come to a conclusion, really, of which one you think is the better investment. So this week, I think it's appropriate to start off with a couple of, you might call them titans or giants, Square and PayPal, which have been in the FinTwit discussion for years now, and they're both having a pretty good day today. We're recording this on Wednesday the 16th. It's about 11:10 in the morning, 11:15 in the morning, and they're both up over 2%. So let's hear, I threw a lot at you, so take that.
So you're going to ask me, Joe, you're going to ask me which of my kids I like best at this point? So I mean, that's awesome. I mean, PayPal and Square, full disclosure, I own both of them already in my portfolio. One of the things that as investors we have to sometimes that we're faced with is we have limited cash on the sidelines to deploy, and we have to make choices, right? So, I didn't buy PayPal and Square at the same time when I included them in my portfolio, right? I had to make a choice. Okay, well,
Right.
This is the one I'm going to own first. And then, later on I had money available. So I ended up buying the other one. So, and that's kind of like one of those ongoing debates that we have to make. And oftentimes we end up making the wrong choice at the wrong time, right? We'll say, geez, I could have timed this entry better. I didn't really get it at the price I wanted to pay. And that's one of the things that our research kind of tries to help out with, right? Because it takes a lot of the noise away and just basically gives you, okay, if we're going to take all of these different data points that tend to, correlate with a stock price going up, right? If we're going to combine all that together into a score, then it allows you very simply to rank them and say, okay, well, which one has the higher score, right?
Yep.
Whichever one has the higher score is the one that I will buy. Now, that comes really into play when you have two stocks that have very different scores, right? So if you have a stock that maybe has a score of 95 and another stock that has a score of 45 in our research, well, then you'd want the one that has the 95.
Absolutely.
It's such a huge spread to the one who has a 45. It gets muddier when you start looking at high scoring stocks and they're only separated by 10 or 15 points, because really then you're only talking about, okay, this one stock scoring really well maybe on this one factor, but this other factor scores well for this other stock, and maybe it only just doesn't score marginally worse than that first stock, right?
Yep.
So you're kind of like splitting hairs in a way, and that's kind of where we are when it comes to Square and PayPal. But there is a difference in score. I mean, PayPal's score currently, I'm just punching it up in the system, is an 80, which in my view, I would consider an 80 still to be a high scoring stock. I wouldn't scare me away. I would buy a stock with a score that had 80 if it had everything else that I happen to look for in stocks. But Square's score is a 95. So I look at that and I say, well, it's not a huge difference in score, but Square would be the one that I would be tilting toward. So all things equal, if I was looking at these two and I said, okay, well, I love both of these companies. I want to own both of these companies, but I can only buy one of the companies right now. I guess the one that I would be tilting you toward would be say, okay, go out and buy Square. And that's, again, that's one of the advantages of having a ranking system, because
Right.
it allows, it removes that emotion, right? It allows you to quantifiably look at something and say, yeah, you know what? If I'm just listening to the data and letting the data point me in the right direction, it's telling me Square's the one to buy.
All right. So now that we've come to our consensus, so looking at the chart for Square since the crash in March, it's a really steady upward trajectory. So for a potential investor, it's tough to find an entry point looking at this chart, because it's like a steady upward staircase basically. So how would you suggest a potential investor try to target an entry point?
Right. And again, we're not technicians, but I've been in the business a long time. And I really do believe that you can use charts to help you gauge sentiment, and you can use charts to help you figure out when's the right time, is this a good time to enter or not, or whatever. We are, Joe, in a weird, this is 2020, right? So everything's weird.
Right.
We are in a weird situation where the markets have had kind of this unbridled optimism. And it seems like no matter what, stocks within certain baskets, these certain industries, just continue to march higher and higher and higher. And I think one of the temptations, the biggest things we're wrestling with as investors, is this whole fear of missing out, right? FOMO, right?
Exactly.
And I guess maybe that tails in with YOLO or whatever. I mean, it's all the acronyms, right? But this whole concept of, okay, well, I need to be in this market. I need to be in this market. You can be selective. It's okay to be selective. Now, I think the story is a little different if you're 100% in cash and you're missing this whole move. But I mean, if you're mostly invested, and you're just talking about some dry powder on the sidelines, like I have about 15% in cash right now. I've been steadily pruning my trees and pulling my weeds over the course of the last couple of weeks. And raising a little bit of cash. So, I mean, if you're mostly invested, you're still making money in this market, right? But the key is to kind of like do no harm, right? Hippocratic oath, right? So
Yep.
you look at, I'm going to share my screen, and I want to look at this chart a little bit more. So let me know if you can see it, Joe.
Yep, it's up.
Okay, great. And listeners, we do post these on YouTube. So if you're listening to us on your favorite service and want to look at the charts, feel free to check us out on YouTube after the show's done or whatever. And don't forget to subscribe and like so you see each one of these when we post them. All right, so we're looking at Square, and you'll see, we talk about this every week with the stocks we pull out. I mean, look at the revenue growth in this company. It's just absurd in a way. 140% year over year last quarter, 64% quarter before that, 44% before that, 41% before that. I mean, obviously just knocking it out of the park on top of growing their business. And then you look at the earnings, and again, I like to see ideally double-digit earnings growth as well. In 2021, expected to grow 51%. But this is not a cheap stock, to your point. I mean, I always look at the 200-day moving average to kind of be my baseline of how extended things are. And you got a stock that's trading at 224, and maybe the 200-day moving average is 125, 100 points to the 200-day moving average. And, it does act like a little bit like a magnet. At some point, you'll probably see the stock trade to the 200-day moving average. But remember, the 200-day moving average is an average of the past 200-day prices. So the 200-day moving average is moving up, right? So who's to say that the stock doesn't go up to 300? The 200-day moving average, ends up getting pulled up to 200. And when it does pull back to the 200-day moving average, you would just be pulling back to wherever you bought it is today, right? So
Exactly.
you don't want to get too cute, because math, right? So there are a few things that I would look at here with Square. One of the things that's interesting is you'll notice that traditionally I like to see more buy volume than sell volume. So more buy volume on up days and less sell volume on down days. And we certainly were getting that through this period right in here from September through November. One of the things you'll notice, though, is that in the very, very short term, buy volume spikes on Square have indicated short-term pullback. So if you look here, for example, you had this huge 34 million share day, and we went only a little bit higher, and then we pulled back about 10%. Then you had this move, huge volume day, and it was within 1 or 2 days of a meaningful decline, 150 to maybe like 140 or 130. And then, you know, you look over here more recently, again, you had a big volume up day, and then you had another 5 days of kind of digestion before it rallied out again. Now, right now, we don't have that volume. There's not a huge amount of buy volume. And I think a lot of people are wrestling with the same thing that you're wrestling with, Joe, which is that you're saying, okay, well, you know, do I really want to buy it up here? So on those up days, you don't have a lot of volume coming in right now. I get torn on this because, you know, if you had a huge volume spike day, then you could say, well, I'll probably get a good entry sometime over the course of the next week. Right now, though, you basically don't have a whole heck of a lot of conviction because you don't have, you know, above average volume like you were having way back in here, right? And you don't have the stock retreating. So the way I typically approach companies like this is in thirds. So if you have a normal position and your normal position is, say, you know, 3% of your portfolio, take 1% at the market today, because it's certainly possible that the stock just continues to run, or it trends out sideways a little bit and then goes again, right? And if you're too firm, in my experience, if you're too firm in saying, you know what, I'm not buying this stock unless it's 150 again, the risk of you missing out on that stock altogether is just too high. If you've done your homework, right? If you've built the foundation for the house and the foundation is strong, are you just not going to build the house now? You're going to leave the foundation there? I think what you do is you go out and you buy some, and then you see how it trades from here, and you look for your spots to put more of it to work. But again, Joe, I mean, you can adjust those plans a little bit, but have the broad stroke plans spelled out, right? Plan your trade, plan your investment, and then trade your plan. You know, invest your plan, right?
That's right.
Don't wing it necessarily. Have it thoughtfully done. So you say to yourself, I'm going to do it in thirds. I'm going to put a percent on now. I'm going to put another percent on in a week if we're still around this 200, we've gone side, whatever that plan happens to be, okay? But have a plan in place for it. And that's the way I would approach Square right now.
All right. Yeah, I'm looking at, so I have a slightly different version of your chart up on my screen on a different computer, so I can't share it, unfortunately. But I have a simple moving average indicator on my chart. And for reference, Square has been above its simple moving average now for exactly a month. So just consistently trading above that point for a month now. So yeah, I think that there's reason to think that there would be a pullback, but at the same time, FOMO kicks in for somebody like me, and I'm like, am I gonna miss out on this if I don't buy it now? I have a habit of trying to wait for that dip and then not seeing the dip happen and missing out. So I've had some negative experiences, but I think that your point is pretty valid.
Well, we were actually just talking about that before the show started, right, Joe? We were talking about how you were personally looking at Etsy, a stock we talked about last week on last week's show.
Yeah,
it's like, geez, I want to buy it, but you know, it's not really giving me any opportunities to buy it. It's kind of that same thing where you look at it and you say, geez, I've done my work on it. I got my thesis. I've done my homework on it. I've read the 10K. God forbid, right? I mean, people actually read the 10K and the 10K.
God forbid we do our research.
I know, right? You actually understand the company that you're investing in, right? So you've done your research. You're not just listening, oh, it's hot on Robinhood or Reddit's talking about it, I got to get in. You know, you've done your work on it and stuff. And then that big question again, it's like, oh, geez. And you know what the biggest thing is, Joe? People don't want to be wrong.
That's true.
You know, you don't want to be wrong because then you feel stupid, right? But it's okay to feel, it's, you know, nothing ventured, nothing gained. And you don't learn unless you're, well, you can learn if you're tracking and journaling, but for the average person isn't tracking and journaling. You know, they're just having these emotions. They're continually being, you know, swayed one way or the other by those emotions, you know. But again, that's why I think taking a measured approach to saying, okay, well, I'm not going to buy it all right now. If I'm going to buy 5 shares of it, you know, I'm going to buy 2, 2, and 1, or something like that. So have some kind of a plan and put it, because you can do it now because there's no transaction fees.
Right.
You know, it's not like, oh, it's just going to be cost me so much to do those 3 trades and I'm only playing with a small amount of money. No, it's irrelevant because it really doesn't matter. So from my perspective, it's better to get some skin in the game. Go out there. If you like the stock, you've done your homework on it, buy a little bit. Hey, you won't have a full position, but if it keeps running, you're still making money. And there's nothing wrong with that. And you know, you'll be watching it very closely because you now have the money, you have money invested in it, right? So when you do get an opportunity at some point, you know, and most stocks give investors an opportunity some point over the course of a 3, 6, 9 month period of time, then you add, you know, you can add more or do more to whatever you want to do.
Right. All right. So with that, I want to shift gears a little bit. This is last week's news, so bear with us. But we had a lot to cover last week, and we didn't get around to talking about SFIX, which is a stock that I have watched very closely ever since their IPO several years ago now. Full disclosure, I have been a shareholder of theirs off and on, but they had a huge breakout last Tuesday, I guess it would have been. Jumped from like 36 to 54, something like that. So almost
trading 64 today, Joe.
Yeah, it's insane. I feel like I missed out a little bit when I owned it. I was kind of like, I was always waiting for that breakout and it never came, and I kind of lost my patience and lost my thesis, if you will. But looking at it now, you know, have they proven themselves, or is this just the magical world of FinTwit and Wall Street bets inflating the price like with a bicycle pump?
You know, I gotta admit, I have been wrong about SFIX. I have been, you know, this is the most important words you can say as an investor is wrong. I've been wrong, right? And then take action on being wrong. And for you know, hey, I'll lay on the sword right now. So I am involved with programs from hedge funds. I have to be long and short in those programs. I was short at one point SFIX. And I was betting against it because I was like, oh, what's their mode? I mean, they just, stuff shows up at your door, and you know, how much of the stuff do you really keep, and what's keeping a Macy's from doing this? And you know, there was all these arguments in my head for why I was skeptical of the company. And of course, the company didn't keep going down. It started to rally. I started to get upside down. I was losing money on it. So I said, I'm wrong. I don't fully understand the story. The catalyst reason I had been short isn't playing out. It's broken. And what? I'm going to stick with that bet against it because, you know, my pride or my ego? No, I'm wrong. So I'm going to get out and I'm going to reconsider it. And if I want to get back into it, I'll get back into it because trading's free.
Right.
You know, transaction's free. And I protected, obviously, a tremendous amount of additional losses. Yeah, I lost money on the trade, but, you know, it's not like a zero-sum game. I took the money that I freed up from that and I deployed it somewhere else and I made money on that trade, you know? So, I mean, it's like, it's, you know, when you realize you're on the wrong side, when your catalyst busts, when, you know, say to yourself, yep, I'm wrong, and make a choice. So now we're faced with a different question, which is SFIX buyable right now? And again, I wrestle with this. I feel like I hate to hedge myself on this, but I feel like I just don't understand the story enough to tell people, yeah, you can go out and buy this thing. Obviously, the earnings were good. People responded favorably to them. But, you know, you look at the good to them is 10% year-over-year growth, you know? So yep. I look at that and I say, well, wouldn't I rather own Lululemon with 22% year-over-year growth last quarter? So, again, then it starts to come down to the ranking system. We've got our scores, and we see that Lululemon has a very high score, and Stitch Fix is a neutral score, has a 75. So you say to yourself, well, there's nothing there. I mean, if Stitch Fix score was 105, because we go up to 115 on our scores, don't ask me why. Go to episode 5.
Episode 5, I'll drop a link, don't worry.
And where we talk about the scoring, the ranking system in more depth, and we talk about how crazy 17 years ago I didn't set this thing to 100, I set it to 115. So anyways, if it would be different, right? Joe, if his score was 100 or higher, I'd be saying to myself, I need to understand this story more. Obviously I don't understand it enough. I need to understand the story more because the score is telling me the stock is going to continue to go higher. But right now it's really not. It's telling me it's neutral score and I don't understand the story. So I'm going to sit on my hands with it and I'm going to focus on other higher scoring stocks instead.
Yeah, I think there's definitely, like, looking at that, at the chart that I kind of traditionally pull up with the moving average. It's, so at the time of recording, it's trading at 63.50 basically. And
that's all-time highs, Joe.
All-time
highs.
Yep. And the simple moving average currently stands at 45.51. So there's definitely an argument there for a pullback, but I would say, like, if it pulls back significantly, I might be looking to kind of re-enter into that.
Well, a little inside baseball here too, Joe, for listeners, and since we're talking about this, I'm going to share my chart real quick.
Go ahead.
So people can see Stitch Fix and see what we're talking about here. You'll see on my chart, I do a little different than Joe. I've got the 200-day moving average, which is my black line. I got the 50-day moving average, which is my red line. Joe, you can see the chart okay, yeah?
Yes, I can.
All right. And then you'll see right here, listeners, at the beginning of December where they reported their numbers, and we had this huge spike where we went from the 30s to almost $50 per share. We're now trading at 64. No, there's no rule, hard and fast rule that says you have to fill gaps. And I'm showing the gap here on that one-day trade where you went from 30 to mid-40s. But very often we fill gaps.
Yep.
So, that's something else to bear in mind, is that when you get situations where you get these big gaps, and the same thing works if it sells off. You get a big gap sell down day, then, usually not the day of the sell-off, but if it sells off again the next day, you can go out and take a little slug of it. And then maybe as a position trade, it'll start to fill that gap up. And then when it gets to some point in that gap, go ahead and liquidate it and trade it out if you're a position trader. But so anyways, so I just wanted to show people that gap and make people aware of it. It has gone parabolic. You've got 7 days to cover short. I'm assuming that the next short update, it'll be less than 7 days, but who knows? I do get some intelligence reports on matters like this. It is one of the more heavily shorted, crowded names, and I think that's one of the reasons that we're seeing among hedge funds. And I think that's one of the reasons we're seeing this covering now, as people are getting out of it. But again, it's a story that I don't fully understand. I'd rather own something else like Lululemon.
Yeah, I agree with you. And one thing that I did while you had that chart pulled up is I expanded the chart out to the max when they IPO'd back in late 2017. And there are several of these spikes on just insane, like way above average volume amounts. And then pretty soon after, it has a history of just plummeting back down to where it was, and actually oftentimes lower than where it was before the rally. So we've said it before on this show, history may not repeat itself, but it certainly rhymes. And so this would definitely be one of those scenarios where I would err on the side of caution. So with that, why don't we try to answer another question I had before we started recording, which was that, and you might have this question too, because I think we've both been kind of trimming our portfolios as of late. And so you said that you've got cash up to 15% now, which is significant. And I don't know what my exact allocation is, but it's close to that for sure in cash. And so in the next few days to a week, maybe several weeks, depending on how long this rally goes on for, why don't we bring up some stocks that are going to be worth targeting?
Yeah, absolutely. And you know, one of the things interesting, Joe, just made me think of when we were talking about pruning trees and pulling weeds. One of my biggest positions is Tesla, and Tesla's being added to the S&P 500. So of course, stocks have been rallying up ahead of that because they recognize, you know, people have been buying stock ahead of that because they recognize how much money follows the S&P 500 and they want to be involved in it. And the stock has been obviously a very good performer since, you know, the news was announced, but it's really kind of gone sideways for about a week and a half. And it's by far became the largest stock in my portfolio. I was up, Joe, 1,500% on it. So I wanted to make some of that real. So, you know, my plan, when they announced the inclusion and the inclusion date, I came up with my plan. Because I'm a big believer, as you know, I've said, plan your trade your plan, right? So my plan was at the time, the week before inclusion, I'm going to sell half my stake. So I'm going to let it all just play out. I'm not going to worry about price. I usually don't set price targets or anything like that. But a week ahead, I'm going to go ahead and cut my position in half. I did do that this week. So I am now still a big Tesla bull. I mean, I still own a lot of it, still a big position because I'm up so much on it. But I did also make half of those gains real, and that helped me boost up my cash position to a point where I feel like I have plenty of dry powder if we pull back to redeploy that in some of the names that we'll be talking about today. But I did want to just touch on the Tesla as a full disclosure, kind of like an example of rules and how to, you know, institute your rules and follow through on them for good or for bad. All right, so that being said, I'm going to share my screen and we'll take a look at some of the stocks in the research that you might be more interested in putting up. You can see I've got the Tesla chart up here right now. But there were a few in the research this week as I was going through that sort of jumped out to me, Joe. I've been really interested in the pet plays. Some people who have listened to the show probably aware that I talked about Chewy in the past as a stock that scores highly in us that we'd be really interested in, and that's obviously been a big winner. I mean, we can just pull up the Chewy chart right now and see how that's just been just to the moon. But yeah, so the one that's caught my eye though from the research this week is Covetrus. And Covetrus, or CVET, is the symbol there. So Charlie, Victor, Edgar, Tom, CVET. Interesting company. They, you know, if you just look at what the snapshot says, it provides pharmaceutical, diagnostic tests, surgical, nutritional products to animal health industry. So think of them as kind of like, you know, the supply partner of both computer IT and pet products to veterinary clinics. All right, so they work with the vets to make sure that they have the products that they need to do their business every day, including, you know, IT hardware, you know, patient billing, scheduling software, and then just, of course, regular products that they use, consumables that they use. I believe that they used to be part of, correct me if I'm wrong, I'm not sure, Henry Schein, I think, and they got spun out from Henry Schein, in 2019. And you can see on the chart from there. We've got about 8 days short interest there, which I kind of like to see in growing stocks, growing companies that are rising. I like to see a high short interest because usually it shows you that the short sellers are wrong and they're going to be forced to buy to cover, and that's going to give you a little bit of a tailwind. You've got 11% year-over-year growth in the most recent quarter, and you've got an expected 12% growth year-over-year in earnings in 2020 and another 10% year-over-year growth in 2021. So CVET was one that jumped out at me, Joe, from the research this week. Another one I wanted to pull up because we're in the East Coast and we're supposed to get some storms. Supposed to get an nor'easter coming through, Joe. So
yep,
batten down the hatches.
Get your bread and milk.
That's right. Rush to the grocery store. Anybody who lives in the snow country knows that you don't want to go anywhere near the grocery store the day of a storm.
That's right. Avoid it like COVID-19.
Avoid it like COVID-19. Yeah, one of the things that we do look at seasonality. Seasonality is part of the research model. Generic is one of the largest makers of power generators, and it shouldn't be this easy, but oftentimes, Joe, you have storms. If the storm delivers and it's a big storm and there are power outages, you'll see a short-term pop in generic. So, the stock has moved up a lot. It's not a cheap stock. I mean, but at the same time, it's one that you might want to have up on your watch list because during storm season, it may pay off to pick up some shares of it. We talked about insurers early in the show. I want to pull up Travelers, which is a high-scoring insurer in the property casualty area, expected to grow earnings per share by 20% in 2021. I really like this setup. I think you get a good shot, especially break above 140 on it. So I would be looking to buy anything in right around this spot and then go up to, if it breaks out about 140, I think that would be your conviction to either take more or that, this thing could have more legs to it. We've talked a lot about semiconductors since we started filming the podcast. Some of the semiconductors have gotten a little frothy. I think that, can take a little bit of profit off the table in some of those semiconductors. One, though, that I kind of like is Monolithic Power Systems, MPWR. So Mary, Peter, Walter, Reagan is the symbol there for listeners. And you can see that I got the chart up here. You've got 54% year-over-year revenue growth last quarter to 259 million. And you've got 28% EPS growth expected in 2020 and another 10% expected in 2021. I love that. I love double-digit revenue
growth. Yeah.
Yeah, and in earnings growth, you've got this stock that's traded sideways pretty much since October. And my feeling here would be if you can buy it anywhere in the 315, 320 range, if this thing breaks out of 350, I think you could go much higher on it than that. So that would be another one I'm looking at. We've talked in the show before about Tractor Supply Company, TSCO.
Yep.
This week I want to bring up Deere, high scoring stock in our research that I think may have some opportunity here. You're kind of flirting with those old highs. If you can bust out of that, I think you could go a lot higher. The revenue growth, obviously, nothing to write home about because, COVID-19. But you do have solid earnings growth. And one of the things with kind of these cyclical kind of industrial stocks is that when the tough times are tough, they usually cut back a lot of the fat. And then when the recession ends or when the buying returns, they're a lot leaner and their profit margins are better and they tend to deliver more to the bottom line. So Deere would be one that I'm looking for there. And see if there's any others that really jumped out at me. I guess the last one that I'll leave us with today, Joe, is Skyworks Solutions, SWKS. Interesting stock. I am long this myself. They one of their biggest clients is Apple, and so they're going to be tied a little bit to how well Apple does selling the iPhone through the holiday season. There have been some rumors that Apple's ramping up its production for the first half on better than expected demand for their phones. Obviously, if that's true, then Skyworks should be a beneficiary because they have more content in 5G phones than they had in 4G phones, more content in 4G phones than they had in 3G phones, more content in you get the idea. As we go up a G, they make more money with every phone that's sold. Apple is not their only customer, but it is an important customer for them. And I think this is a stock you can kind of go out and buy right around these levels and sort of let it play out from here. Again, you've got solid double-digit revenue growth last quarter, year over year. And if you look at the earnings in 2021, 23% growth, and in 2022, 13% growth. So there's a smattering from this week's research, a smattering, Joe, of ideas for people.
That is an excellent smattering. Yeah, as always, I will put all of these into the show notes, and I'll be tweeting about these. They'll be in the YouTube description, Spotify, wherever you listen or watch. So yeah, with that, I think we'll leave it at that. Do you have any parting words of wisdom for us before we head out?
No, not today. I got nothing, Joe. I got
It's
nothing.
been,
I mean,
yeah, it's just been kind of like a boring week. We were talking like before we started recording, like, what are we going to talk about? It's been so normal. What is this? Like, is this a preview of 2021? I kind of, on one hand, I hope so, but on the other hand, we could definitely use another topic or two to talk about.
yeah, well, and if listeners have anything they'd like to hear us talk about on the show, feel free to mention the comment. Make sure you like and subscribe to the YouTube. Throw it in the
Absolutely.
comments or hit us up on Twitter. We're more than happy to answer some questions in real time on the show.
Yeah, for sure. All right, so we'll leave it at there. We'll see you all next week. Take care, everyone.